Hey guys, welcome back to the show. My name is Leo, and in this video here, we're going to be doing a stock analysis on Taiwan Semiconductor Manufacturing Company Limited, located in the lovely country of Taiwan. I've been wanting to do this company for quite some time. Some lovely users on Reddit community on the value investing thread suggested I do this company, and you know what, I thoroughly agree with them. Without further ado, let's jump into the intro and let's do a deep dive into Taiwan Semiconductor Manufacturing Industry. just roll the intro. Alright, so we have Taiwan loaded up here in our stock research tool. We're going to first jump into the company metrics and gauge where the company's been in the last 5 years and try to grab an understanding of where they're predicted to be heading. With Taiwan Semiconductor, our PE is standing at around 25.73. We're roughly in that 5-year range. We want this to be under 22.5. Now these EPS numbers, they're going to be a little bit high. They report, I think, their earnings and metrics in Taiwan. I don't know what the currency that they use in Taiwan dollar. I'm not sure if they use the dollar or not, but this is why the extremely high numbers. Eventually, when you do a price analysis, we will reflect that back into US dollars. Based off these metrics here, yeah, increasing on the EPS, phenomenal. ROE's also been increasing, and it's over 15%, which is also great. Profit margin, slight increase on the profit margin over the last 5 years. They are up on their free cash flow, which is phenomenal. They do pay a small dividend of 1.71%, and if it's at $265.8 billion, that is somewhat convoluted, because that means that dividend is not exactly safe. So here's the dividends paid, folks. It's running real close to that free cash flow line. Granted, they look like they've been able to pay it over the last few years, no problem, but this is 2021 numbers. Yeah, that's showing a little bit of a decline. This might be a problem, evidently, in the future. So now, return on invested capital, we actually don't have a number for this, unfortunately, but our 5-year average number is 23.84, which is phenomenal. We want that over 10%, and we have that. Almond Z-score, however, it's 1.22. We want that to be over 3, and we don't have that. And Piotrowski score is a 6 out of 9, 9 being our highest score. 6 is pretty mediocre. Based off just the company metrics here with TSM, I'm not too thrilled. There's nothing that is really blowing me away other than the return on equity, but I'm really more so concerned about the free cash flow and not being able to pay off this dividend in the future, and if they have to potentially drop it altogether. Let's jump into the financial evaluations and determine where this company sits. So here's our list, folks. We are scoring about an 8 out of 10. So we're 8 out of 10, and we'll go through these metrics right here. Current ratio, we're not reporting a current ratio. I don't know why. It's just, I don't know, maybe they just haven't reported it yet and my software is just not picking it up. But PE is 24.51. We want this to be 22.5 or under. We don't have that. Current ratio, I don't know what it is, so it's not going to get any points. Return on equity, we want this to be over 15%, and we have that. And so that's going to get a point there. EPS growth, obviously phenomenal growth, but I have to see what this number is in US dollars. But still, there's a growth nonetheless, so it'll be reflected either way. And debt to equity, I don't believe it's 0%. I don't believe it's that for a second. But let me just do a quick little check here in our income statement and determine that. Or sorry, our balance sheet. I want to go to balance sheet, not income statement. So long-term debt, we're showing 0 across the board for liabilities. Not even showing any assets not being reported. Not that they have 0, net 0, because that would just not make sense at all. So I'm gonna call that a miss. Debt to equity, current ratio, we have no numbers for to be accounted for. Moving on to share dilution here, we do have a slight decrease in shares, which is phenomenal to see. We want this number to be decreasing or staying the same, ideally decreasing, because when a company is diluting you with shares, you're effectively owning less of the company, but when they obviously decrease the amount of shares, you're owning more of it. 5-year net income growth, we have a huge increase of 72%. And same with free cash flow growth, and a return on equity being over 10% here at 23.84, followed by a 5-year revenue growth of 11.21%. So far, these numbers are all being checked off here. I don't know. I mixed feelings about it. I like the industry. I like the company. They're a huge player in the semiconductor field. They manufacture, I believe, for AMD, NVIDIA, Qualcomm, Samsung, just you name it. And I believe they're having a partnership up with Intel. So they are a huge player, and I think they are the largest foundry. Those are my thoughts on the financial valuations. It's scored an 8 out of 10 based off these metrics here. Current ratio and debt to equity, that score may have brought the score either higher or lower, or, well, it's ranking it a 1 here because it's not, obviously 0 was reported. So it's realistically, that score should be a 7. But yeah, it could have been a factor whether the score is actually a 7 or still an 8, or it could have been higher, could have got a 9 if that current ratio is good. But regardless of what I think, let's go into a price analysis here and determine what's a proper price to pay for this business. So we have a lot of revenue numbers as always to try to choose from. I like to hover between the 5-year and 10-year numbers and try to give conservative estimates because I want to be on the good side of wrong. What I mean by that is I want to choose the lowest amount that this company can do over the, let's say, the next 10 years. And if they outperform my evaluations, phenomenal. That means I'm on the good side of wrong. But if, let's say, if I am right and they perform my numbers, at least I know I'm paying a price with a decent margin of safety. Now, if you've liked the video up until this point, please hit the like button and the subscribe button for more content like this. I thoroughly enjoy your support. It makes me feel warm and fuzzy inside. So, without my long-winded explanation, I'm going to jump into this and just plug away at some numbers. So I'm going to go 9, 10, and 10.5. Profit margin, I believe they're going to probably stay around the same profit margin. So I'm going to probably go 30 on the low side, and then go 31, 32. Free cash flow margin, I'm going to say, let's do 16, 18, 19. And price to free cash flow. Now these numbers are going to get a little bit skewed here because we have 57 on the high side. So I'm going to go with the 14, 16, 18, which is my conservative high ratios. And we'll do 14, 16, 18 as well on the PE ratio, plus our desired return of 13%. It's not looking too good, folks. We're cashing in this company here at $72.65 for our average calculation of everything here. Our average is 73 on the high side, 88, and 55 on our low end for a conservative estimate. Yeah, this company, I think it's where do I stand with Taiwan Semiconductor? I believe the industry is going to boom up a lot, and there is a shortage, so they have a lot of business and demand their way. So you know, these revenue numbers might be completely wrong, and they might be growing at a higher percentage over the next couple of years just due to the fact of this whole surge in demand for these chips. Now, with this whole overlooming aspect with China on their heels, I'm not sure how that might affect them in the future if things progress and go forward with, you know, any other political tensions. I'm not too sure. I can't say 100%, but granted, with these numbers here, I do believe that the company needs to fall just quite a bit. Now, granted, this $103 price that it's currently at right now, not too bad considering from our highs of being 145. Now, I would like to see these numbers ultimately come in for our current ratio and our debt to equity to see where our debt levels currently lie, but I'm gonna say, and the company, based off what I have here, is pretty solid. It's just mispriced based off the current evaluations. That's if you believe this price here. Now, what would make this company go green? Let's see. If I do the 11, 13, and 16 revenue growth, yeah. Oh, okay, I hit clear by accident. It only hits on the high side with a 16% revenue growth. We'll get our 145 justified price. If you think that's what's gonna happen, then you know what? Well, it's not even there just yet. But if you agree with these numbers, then you know what? It would be a buy all day long. But yeah, my final thoughts on semiconductor company. Wait for it to come down. And I'm gonna put a little watch list until it gets to that $75 price. And if it goes beneath that, then it might be something to be worth picking up. At the current moment right now, I'm just staying away from it. But granted, remember, this is all just entertainment. It's not actually financial advice. You have to do your own due diligence. And when you're researching these companies, luckily I have the software here in front of me that helps me do it like in an instant. So those are my thoughts on Taiwan Semiconductor. Yeah, just mispriced, just a little bit overvalued. I have to do some more due diligence and see where those debt levels are currently at, and once they're reported, I'll definitely make a follow-up video and I guess digest these numbers once again. But yeah, guys, that's the video. Thank you so much for watching. I'll see you in the next one. Make sure you hit the like button and the subscribe. Thank you so much.